Hey guys, welcome to another episode of Tax Talk with Joel, and in today's episode I'll be explaining how you can avoid paying taxes legally and ethically. This is actually one of my favorite topics to discuss because unfortunately a lot of business owners are unaware of how they can do this. We all hear in the news that the rich pay little to no taxes, yet small business owners pay an arm and a leg. Why is it that Amazon made billions of dollars in 2018 yet paid $0 in taxes? Why is it that Trump made billions of dollars in 2017 yet only paid $750? What do they know that other business owners don't? Well, I'll be covering that in today's video. So the first thing we need to understand is that the tax laws are made to benefit entrepreneurs and real estate investors. Why entrepreneurs? Well, entrepreneurs create businesses which eventually lead to the creation of jobs. Because jobs help stimulate the economy, the US government is able to provide tax incentives to entrepreneurs. One of those tax incentives, for example, is being able to deduct business expenses like your cell phone, your internet, and your automobile expenses. W-2 employees, you're not allowed to write off business expenses unless you start a side business. This would allow you to turn some of your personal expenses into business expenses. You're already paying for these expenses anyway, so I would encourage you to start a business to make them deductible. But beware of the hobby loss rule. If you're only starting a business to write off these expenses and there's no motive for profit, the IRS can disallow these expenses, so make sure to document your marketing efforts and your business plan in case the IRS selects your tax return for examination. As I mentioned earlier, real estate investors also get similar incentives. Why real estate investors? Because they help create affordable housing for the community, which in turn helps stimulate the economy. Since they help the economy by providing housing, the US government allows real estate investors to write off business expenses like repairs, maintenance, and depreciation. Depreciation is probably the best tax write-off. Why? Well, what typically happens to real estate? It typically appreciates in value. So even though the value on your properties are likely to go up, the tax laws allow you to reduce your income with depreciation. Real estate investing is one of the biggest wealth creators in the world, and it is used by the ultra wealthy to help them legally avoid having to pay taxes. Now, bonus depreciation has changed over the years. For example, prior to the Tax Cuts and Jobs Act enacted by President Trump in 2018, bonus depreciation was 50%. The Tax Cuts and Jobs Act increased bonus depreciation from 50% to 100% for assets acquired after September 27th, 2017 and before January 1st, 2023. So we've had 100% bonus depreciation for the last 5 years. However, as of 2023, bonus depreciation is now 80%. In 2024, bonus depreciation will be 60%. In 2025, bonus depreciation will be 40%. In 2026, bonus depreciation will be 20%. And by 2027, bonus depreciation will be 0%. Now, although there are no guarantees for the future, I do expect there to be an increase to bonus depreciation before it expires in 2027. But here's why bonus depreciation is huge. Let's say your income was $100,000 last year in 2022, and you decided to purchase a vehicle for $100,000. If that vehicle weighed more than 6,000 pounds and was used 100% of the time for business, you would be able to write off the entire purchase price of $100,000 regardless of your down payment. Your down payment actually has no effect on your taxes. You could have financed the entire vehicle and still qualify for bonus depreciation of $100,000. So if your income was $100,000 and your bonus depreciation was also $100,000, that would mean that your taxable income is now $0, which means you would pay $0 in taxes. The best part of this example is that depreciation is a non-cash expense. When you go to the bank, the lenders would actually add back the depreciation of $100,000, telling the bankers that you actually made $100,000 of income, even though your tax return shows $0. This same strategy can also be used by real estate investors. For example, let's say your income is $1 million and you decided to purchase a commercial building for $2 million. Typically, this commercial building would have to be depreciated over 39 years. Let's say the land is worth $400,000 and the building is worth $1.6 million, while the land cannot be depreciated. So if we were to divide 1.6 million by 39 years, that would mean that I would get a depreciation deduction of $41,025. Now, although I wouldn't mind getting a depreciation deduction of $41,025 every year for the next 39 years, it's also really slow. Remember, your income was $1 million. So a depreciation deduction of $41,025 would mean that your income is now $958,975, which is still pretty high. However, let's say you do a cost segregation study instead. Well, under this strategy, engineers would separate the building into smaller lives. For example, they would put a value on the roof, the flooring, the windows, and the HVAC. These assets typically have a life of 20 years or less, and any asset that has a life of 20 years or less qualifies for bonus depreciation. So let's say that the engineer stated that of the $2 million, $400,000 was the value of the land, meaning the building's value is $1.6 million. So far, nothing has changed. However, by now doing a cost segregation study, the engineers have separated the value of the $1.6 million building. Let's say that per their studies, the value of the assets with a life of 20 years or less was $1 million, and the remaining $600,000 had a life of 39 years. Well, the assets with a 20-year life or less that are worth $1 million would qualify for bonus depreciation. This depreciation would be a deduction on your tax return of $1 million, which makes your taxable income $0. Well, $0 in taxable income would mean that you would pay $0 in taxes. And you can literally repeat this strategy year after year and pay $0 in taxes every single year. So this is how the rich pay little to no taxes. There is no secret. It's just a matter of either you know about it or you don't. Tax laws were written to help business owners, and if you're a business owner, that means you can also take advantage of these strategies. If you need help implementing any of these strategies or would like a free tax assessment, go to sandovaltax.com/YouTube and schedule yourself in for a free 15-minute discovery call to find out how we can be of service. You can find the link in the description down below. Again, if you found this video useful, please like, comment, and subscribe. And if you want to be notified of when I upload new videos, go ahead and hit the bell as well. That's all for today, guys. See you guys in the next video, and have a great day.